should be covered, should be more or less covered for the foreseeable future. All in, if you look at the right, where the valuation and the target price, the RNAV is actually 80% higher than the 30th June book value. So per share, it works out to $1.47. 30% discount will be $1.03 target price. We initiated a trading buy call at 83 cents, and it actually went up just a little bit by 1 cent, which is pretty insignificant. We're still looking at roughly 30% upside, inclusive of another 4 cent dividend next year. All right, heading on to my colleague.
Hi. Hi, morning everyone. Just to give an update on Singtel's first quarter results, which they announced last week. Right, net profit was down 17.4% year on year. That was mainly due to the 150 million of exceptional gains that was recognized in the previous year. That contributed due to the dilution of Airtel's stake, right, in the first quarter of fiscal year 14, right. Adjusting for exceptional gains, underlying core net profit for the quarter was down 1.8% year on year, and that was mainly helped by strong performance gains from its regional mobile associates. Just to give a more breakdown on the Singtel's performance, right? For the consumer business, Singtel continues to gain strongly on its mobile and Mio TV business. However, there was a drag from Optus, mainly due to the reduction in mobile termination rate as well as a weaker Australian currency. Overall, EBITDA for the consumer business was up to 2.2% year on year. For its enterprise business, its the key competition in the national broadband market was a drag for the Singapore enterprise segment. For Optus is flat year on year. So the overall contribution in EBITDA for the enterprise segment was down roughly 7.4% year on year. Overall, how the net profit was down, and that was mainly due to strong performance gains from Airtel as well as Globe Telecom, mainly due to the higher mobile data revenue as well as the increase in subscriber base. At this current moment, digital live business still contributes negative EBITDA, and it still accounts for a very small portion of overall earnings. Just a recent announcement on Singtel's new postpaid plans. It's mainly gonna replace its existing postpaid plans. So the new plans will have integrated Wi-Fi service along with its 4G service, and that's gonna replace the existing plans from 19 August onwards. These new plans will be applicable to new and recontracting customers, and generally they will cost an additional $3 per month as compared to the current existing postpaid plans. So in view of this, we think that the new Wi-Fi integrated plan is going to drive higher mobile revenue in the Singapore consumer business due to the higher pricing. However, some of the risk is that it may risk losing some mobile subscriber, especially those that are not on the bundled plans, as is Singtel's competitors currently are charging lower pricing. If you know that StarHub has recently announced that it will be charging additional $2.14 for its 4G services for the middle of the year. M1 has yet to announce any revision in pricing. However, we do think that its competitors may increase pricing in future. Also, do note that this risk is also mitigated by the fact that the postpaid subscribers are on the 2 years contract, and hence we do not really think it's a big risk for Singtel's losing this market share, right? Singtel also continues to pursue growth in the enterprise space, offering more bundled services to the SMEs as well, and in areas of unified communication, cybersecurity, as well as the cloud services to the larger enterprises, right? On a positive note, FX currency also seem to be stabilizing, especially on the Australian dollar. So hence, we do think this will help to improve the outlook from Optus. However, we do have some reservations as Optus currently is still losing its mobile subscribers due to the dominance of Telstra in Australia. Right. In view of the improving outlook into FY16, we revised our target price to a higher of $3.97 compared to our previous target price. We are still holding on our neutral recommendation. Right.
Hi, good morning. Benjamin here. So, Kim Heng released their results last week. So, if you guys remember, 2 weeks ago there was a profit warning that was issued by them, and we got more confirmation over their results for the last quarter. Right. So, first half 2014 revenue is 43.8, net profit is 5.5 million. Right. So, as expected, it was a disappointment on both their margins and the core business, which, just to remind you, is the offshore rig servicing side, which they do repairs. Right. So the key thing is that the first half revenue actually increased by 7% year on year, right? But net profit it dropped by 32%, right? Which is also which is what they announced previously during the profit warning. Right. So second quarter revenue increased 3% year on year as well, right? But net profit also dropped substantially by 66%. So there are two key reasons for the drop in profit, which I think I did mention last week as well. First of all will be the delays in the arrival of their customer rigs, right? So more than 80% of the revenue is dependent on the number of rigs that they service. All right. So also on the value as well as the margins on the rigs that they service. So for the last quarter, a couple of the very large contract value projects they were supposed to undertake to repair the rigs vice, there was a delay, right, in terms of the arrival into the Singapore waters and into their yards. Right. So this kind of delays sometimes this kind of delays is something that they cannot estimate because it's dependent on the contractors, right, and operators of the rig. Sometimes the contractor rig might be extended in terms of drilling at the oil well. So let's say if it's delayed by 30 days or 60 days, right, this will fall out of the capturing time period for the previous quarter. As a result of that, right, the revenue over the repair side, right, we will see a drop in that. Right, and consequently, the revenue is up because of them selling 3 vessels last quarter. Right, so for vessel sales, which we mentioned previously as well, that is not it doesn't form the core business, and vessel sales tendencies and margins are also lower as well. So for repairs of rigs, usually the margin is about 40 to 45%. Right, for vessel sales, last quarter they clocked only about 11%. So as a result of that, the impact that we see is that we have higher revenue but much lower net profit. Right, so the key takeaway that you have is the current forward commitments, which is somewhat like order book is about 86 million. Right, so 40 million of that is from a master service agreement, which they're supposed to service for large rigs. So it's huge contract sizes. Right, so more than 50%, which a majority is supposed to be recognized as revenue in FY14. Right, so assuming they can recognize at least 50% of this, excluding any ad hoc projects that come on, right, the revenue for this year is definitely higher than FY13 wise, all right. But we have adjusted the projections over the margins as well as the net profit because of the hit for this current quarter. So our target price is revised downwards slightly 29 cents, right. Call is still buy, right. Another thing I want to bring up as well, since I'm online, right, is that OCBC has announced a rights issue this morning, right. So they're going to issue a 148 rights issue. Right, the issue price is about 25% discount to last Friday's closing price at 10.20. So the issue price will be at $7.65. So they're looking to issue about 440 million shares, right? And this will dilute their earnings by about 1 to 2%, right? And consequently, we'll see that their core common equity tier 1, right, will be reduced as well post the consolidation of Wing Hang Bank. Right, so the briefing for the analysts will be in this afternoon. So look out for a report either by the end of today or by tomorrow for further details on this. Right, thanks.
good morning everyone. This is Lucas, property analyst here. So, okay, today I'll be touching on for Cinemas Land, just an update for the Cinemas Land results which came out on Thursday last week, and also on CDL, which was also last week, second half of the week. So for Cinemas Land, basically the story here is that their core activities, okay, are still doing very well. As per the result is within our estimates. Let's just put it that way. In last year, in 2Q113, there were some exceptional gains, about 45.8 million. And then at a point in time, there was no issues when it comes to the financing cost. Basically, they're just riding on the fact that they did not actually did much last year, except for selling some land banks. So as compared to this year, so the PATMI was actually down 52%. You did not hear wrongly, it's actually down more than half. Okay, but the major reason is because in last 2Q13, there was an exceptional gain whereby they sold one of the land banks away, and they registered quite a fair bit of profits from the sale of the land. For 2Q13, in terms of core activities, revenue was up 3%, gross profit was up about 5%, operating profit is up about 3%. So if we were to exclude all of the one-off items from 2Q, you realize that the earnings are also up anywhere between 3 to 5%. So there's really not much cause for worry. Our forecast have already taken that into play, and the target price remains unchanged at 97 cents. Largely, the investment merits is still the current land bank, the ability to extract the value of the land bank by the management, and also obviously the strong balance sheet that they'll be utilizing to go on more expansion. So no cause of worry. We're still having a target price of 97 cents. Okay, so moving on to CDL, just to give you a broad highlight the numbers. If you guys want more detailed update, you can look at the report from last week. But we received revenue up 6%. PATMI is down 32%. What happened once again in 2Q13 last year? There was a bit of divestment gains. Okay, not a bit. There was a lot of divestment gains, and principally coming from the divestment of an industrial site at Pasir Panjang. So this quarter, the PATMI is down 32%. But once again, let's look at what they are actually their core earnings, what their core operating activities. For if you take away all the divestment gain from 2Q13, you're talking about a close to 90% year-on-year increase in terms of PATMI and what they call core earnings. All right. So we feel that this is actually a very good set of results, and there's actually once again there's no cause for worry here. There's a steady progress for projects in the UK, and there should be more acquisition coming up on that front. That will be more on the hotel side, which is from their MNC side. In terms of CDL, the group company itself, they're looking at some China projects. They're ready for the sales launches. I think there will be 2 or 3 development sites in China. In terms of other opportunities overseas, they'll also be looking to Japan and Australia. And on top of that, they are going to go into this new business segment called fund management. So yeah, things are looking very exciting for them as of now, especially with the new CEO which came from a fund management background. Definitely this is something that is a positive direction forward. In terms of residentials, the 3 ECs profit are not launched yet. It's fully sold, and the completion is just around the corner over the next 3 to 4 quarters, or rather the upcoming year. So yeah, look out for the jump in profit from the 3 ECs. Cocoa Palms and Commonwealth Towers, they are about maybe anywhere between 60 to 80% launch, and their sales are also very encouraging. So profits from there is not launched yet, and the construction is going to start within the next 2 quarters. So you see the profits from these 2 coming in soon. In terms of net gearing, is about 33%, including our estimated rebuild gains. Their net gearing is about 22 to 24%. So once again, it's at healthy levels. It's not at the historic high of 50+%, so there's really no cause of worry here. And they do have quite a fair bit of debt headroom. Okay, if they were to want to embark on some acquisition path. So yeah, these are all very, very strong points, and we don't see any changes in our outlook towards them. Key points, we are still looking at very good sales numbers from their residential sites, and they are clearing up most of their residential backlog already. So whatever is remaining, well, it's just going to come be launched, and the sales, we do not expect to see much weakness in sales on that front. And moreover, in terms of residential exposure, they are starting to taper downwards. In terms of growth profile, for acquisition, it will be one source, all right, and the other source will actually be their fund management product. So on that front, we look at their profit growth profile to be actually quite good. And lastly, in terms of recognizing our profits, okay, basically, if you have to dial back into their reports, into my reports and also my initiation, you can realize that there's quite a huge backlog of profits from their China projects, and so there are ECs that's waiting to be recognized. So you do expect a few key share price drivers to actually come in over the next 3 to 4 quarters. So yeah, our call still stands. We're having an accumulated call at $11.26. All right, I shall hand it over to my colleague.
Hello, morning. Next, we are going to cover on Hobby Land. Hobby Land last Monday has released their results. The second quarter revenue has went up to about 26.8 mil, mainly from the higher contributions from the offices in Singapore and London. The PATMI was at 12.2 mil, about a drop of 52.2 year-on-year due to the gain of the disposal of Hotel Windsor last year on the last year 2013, and also the losses from the joint control entities. Earnings has, if you look at on a quarter-to-quarter basis, the earnings has actually improved with higher revenue, mainly from the offices. Rental income, because right now is for Hobby, the Metropolis, although it's a 95% lease already, but the moving in tenants is only at the moment about 68%. From what we understand, the tenants will progressively move into the premises, and the rental income should improve in the coming quarter when the occupancy rates improve into second half of 2014. In lieu of the weak residential market outlook, we feel that for this year there should not be any substantial residential sales contribution, and mainly it will be from the offices rental. From what we understand, Hobby also has launched their Australia residential project Pearl in Melbourne. The management has revealed that about 60% of the launch units have been sold. Since it's an overseas project, so they will only recognize the revenue when the project has been completed. So we estimate the development income from the residential project will only come in and boost the earnings in the year 2015 or early end 2015 or early 2016 when it's completed. So for this, we feel that the recurring income of the investment properties will stay resilient, and we maintain our accumulate rating with the target price of 2.50. Next, we move on to Amara. For Amara, the second quarter revenue was up 10% year-on-year. Hotels segment is still the major contributor, contributing about 64% of the revenue, with about 32% from the property investment and development divisions. And the PATMI has actually doubled year-on-year to 4.6 million. On overall, the first half of the performance is in line with our expectation, where the first half of the revenue account about 46% and the PATMI account for 31% of our full year estimates. The performance for the second half should improve with the traditionally stronger hotel demands in the second half of the year. A slight update on the Amara Bangkok opening was actually delayed and is currently at the final stage of the development progress, with interior finishing pending completion. The hotel is projected to begin the operations in end of the year and be fully operational in year 2015. So we estimate the Amara Bangkok to contribute about 20 to 25% to the hotel revenue once it's fully operational by then. On the whole, we feel that the Amara bottom line will grow within the next 2 years with firstly the completion of the overseas hotel development in the pipeline, and second, the higher share of profits of associates when they recognize revenue from the fully sold project City Life at Tampines, where Amara has a stake of 40% is completed in 2016. So we maintain our buy rating with unchanged target price 70 cents. Next, we move to First Resources. First Resources, the first half of the net earning actually down about 30% year on year to 71.1 million, accounting for our 31% of our full year estimate, which is slightly below our expectation. This is mainly impacted by lower selling price. As you know, last year, First Resources, they actually lock in the forward sales for their CPO at a very good price. So for this year, they actually lock it more towards the current spot price. So this is actually impacting on having a lower performance, and also mainly of a higher effective tax rate and non-operating expenses. They has announced an interim dividend of 1.25 cents per share. The EBITDA for the plantation and palm oil mill actually fell about 22% year on year, mainly due to, as I mentioned, the lower selling price for CPO, which is also partly driven by the soybean price. However, the better refinery margins of about 157 per US $157 per ton in second quarter actually pushed for a jump for the refinery margin EBITDA. This is mainly due to a better mix of the refined product sales. So overall, moving into the second half of the year, we expect the refinery margin for the downstream products to stay healthy. Firstly, with the lower feed cost, since we expect the CPO price to still remain soft, and second, also of better demand prospect for the biodiesel as the palm oil price weakens against the crude oil price. The higher CPO production in the second half of the year will mitigate the lower impact of the lower CPO selling price to support the upstream business. We actually overall we cut our earnings forecast by about 5 to 12% for this year and next year accordingly. Our target price has actually reduced to 2.58. However, with recent weakness on the price, it actually gave a potential upside of more than 20%, and therefore we upgrade our rating to buy. Lastly is the update on Golden Resources. Golden Agri Resources. For Golden Agri Resources, they post strong revenue growth of about 38% year on year for second quarter, but the earnings is pretty disappointing. Overall, it's actually below our expectation, mainly due to the higher downstream raw material costs and negative crushing margins, which is partially offset by better upstream performance. For Golden Agri Resource, first half of the CPO production is actually up 15% on the back of the FFB recovery and an increase in the mature estate. The production growth forecast will now be on the high end of its initial 5 to 10% projection. The management is now more confirmed that it will stay at about 10% growth. The upstream business performance on the whole outlook stays positive with the stronger production in the second half of the year. However, the downstream business, the refinery and the oilseeds crushings will still continue to stay challenging in the coming quarters. The management feels margin may improve slightly, but overall will still remain compressed. With the outlook that we have on this, we maintain our neutral rating with the target price of 0.55 cents. Next, we'll move on to our next colleague, Richard.
Hi, good morning. This is Richard, analyst for transport. Last week, ComfortDelGro announced their second quarter results. Revenue was up 11.9% year-on-year to 1.02 billion. Operating profits was up 6.5% to 120 million, and net profit at 75.7 million. That's up almost 10% year-on-year. An interim dividend of 3.7 cents was declared, which is up from last year's 3 cents in 2Q FY13. So the interesting thing about ComfortDelGro is that for the first time, their quarterly revenue crossed the 1 billion mark, and the largest contributor to this increase was their bus and taxi business. The bus business accounted for 71% of this increase in revenue, and taxi accounted for 22% for this year-on-year revenue growth. Where the bus revenue increase in bus revenue came from was from the Metro line, which is the bus operations in UK, London, and the fare adjustments in Singapore, which came into effect in April. For the taxi business, the revenue growth came from the newer and larger fleet in Singapore, combined with the cashless transactions. The newer and larger fleet will have higher rental rates, so that's how they increase their revenue. And the same in China, they had newer and larger fleet of taxis in their China operations as well. So now we move on to the expectations for the third quarter of this FY. We're expecting that the bus contribution to ComfortDelGro is going to taper. Firstly, because the Metro line UK was first consolidated in third quarter, and so the next quarter is again the third quarter, and they have seen 4 quarters of the consolidation of this new business. Next is Australia, Region 4. Their management is guided that they're expecting to be recontracted at a lower margin as well. On the taxi front in Singapore, they currently are replacing their Toyota Crown and Hyundai Sonatas, replacing to the Hyundai i40. So with newer taxi fleet, taxi rental rates will go up as well. And 2 weeks ago, ComfortDelGro also announced an acquisition of Blue Mountains Bus Company. This in Australia. They're expecting this to contribute from the fourth quarter of this financial year as well. And the effect of this acquisition is that their existing fleet of about 1,000 buses in Australia will be increased by 101. So this is about a 10% increase in their fleet for Australia. Okay, moving on to SIA Engineering. We reinitiated coverage on SIA Engineering last week. The report is available on Poems. So first, go through the company snapshot, company background, business segments, talk a bit about their network of associated companies, their facilities, and wrap up with the outlook for the aviation sector, briefly mention about the headwinds, and conclude with the investment merits for SIA Engineering. So the share price, it closed at 457 last week, and we currently have an accumulate rating for SIA Engineering at $4.92. Company background for SIA Engineering. SIA Engineering is a maintenance, repair, and overhaul service provider headquartered at Changi Airport. It was formerly the engineering division of SIA, and it was restructured to be a subsidiary of the SIA Group in 1992. Through the restructuring, the engineering division was able to expand outside the scope of the parent airline's carrier business. And in doing so, it supported the modern fleet of SIA and built up its capabilities in the MRO arena. The SIAEC was subsequently listed on the Singapore Exchange in 2000 and is currently 78% owned by SIA. SIAEC has an extensive network of 25 JVs and subsidiaries spanning 9 countries: Singapore, Australia, China, Indonesia, Ireland, Philippines, Taiwan, USA, and Vietnam. SIAEC has certifications from 26 airworthiness authorities, is a MRO service provider to more than 80 international airlines worldwide, and provides line maintenance services to more than 50 airlines at Changi Airport. Now I'll go into the business segments of SIAEC. It has two business segments, line maintenance and repair and overhaul. Line maintenance contributed 37% of its revenue in the last FY. Line maintenance, their line maintenance business has a network covering 34 airports in 7 countries, and it provides routine services and non-routine services. Some examples of the routine services that this business segment provides is portable water, toilet servicing, pushback and towing, while non-routine services would be things like maintenance of the in-flight entertainment systems, cabin repairs and maintenance, and toilet and galley waistline cleanings. Next, moving on to the next business segment is repair and overhaul, which is also segregated into airframe and component and fleet management. The SIA Group has 6 hangars in Singapore and another 3 in Philippines. This is supporting their airframe and component overhaul business. So some examples of this are the engine overhaul business, cabin modification, and passenger to freighter conversion. Fleet management is a fleet monitoring and support service for airlines. SIAEC manages a fleet of 170 aircraft from 12 airlines. What fleet management entails is maintenance schedule planning, quality control, inventory supply, and logistics and supply chain management for the airlines. SIAEC has a network of 25 JVs in 9 countries and is a significant contributor to SIAEC's net profit. Share of profits from associates and JVs contributed to 61% of their net profit in FY14. And the dividends from the associates and JVs contribute significantly to SIAEC's internally generated cash flow. So there are 5 types of services that the JVs are grouped under, which is engine services, component services, line maintenance services, base maintenance services, and cabin modifications. Their associates and JVs are spread. Their associates and JVs are spread across 9 countries: Singapore, Hong Kong, Australia, Indonesia, Philippines, Vietnam, Taiwan, USA, and Ireland. And they also hold a long-term investment, which is a 10% stake in Hong Kong Aero Engine Services. As mentioned before, SIAEC has 6 hangars in Singapore, and each of them has a specialization. You can view it on the slides here, and they have 3 hangars in the Philippines. They recently opened their 3rd hangar in June 2014 this year. And lastly, they have 1 engine test cell facility in Loyang. In the interest of time, I will only be presenting on the summary of the key points. For the charts, graphs, and details, please refer to the report available on POEMS. But to summarize, actually, from the data and research presented by ICAO, which is the International Civil Aviation Organization, the research shows that for the Asia-Pacific region, it holds the largest market share of capacity, and it grew 7% in 2013. This in comparison with the global rate of 4.6%. Asia-Pacific region also holds the largest market share of traffic, and it also grew 7.2% in comparison with 5.2% for the global average. So in short, what we see is that capacity and traffic in the Asia-Pacific region grew at a faster rate than the global rate. And ICAO is forecasting that the traffic will grow at 6.4% and 6.8% respectively in 2014 and 2015 for Asia-Pacific region. compared to 5.9 and 6.3% globally. Traffic as measured by RPK. Further research by ICAO shows that traffic as measured by RPK also always recovers from crisis and continues to expand. You can refer to that chart in the initiation report as well. And lastly, for Singapore specific, Changi Airport Terminal 4 will be operational in 2017, and third runway is expected to be implemented by 2020. So in short, everything points towards growth for the aviation sector, specifically in Asia Pacific and Singapore. Now move on to the prevailing headwinds. Globally, we've seen a spate of aviation incidents weighing on passenger confidence and safety concerns. Regionally, there was some political instability in Thailand and disappearance of MH370. So this resulted in lower visits by Chinese tourists to the region, with Singapore as a collateral damage. Chinese tourists are the second largest group of visitors to Singapore after Indonesians. Competitive landscape for airlines is the landscape for airlines is competitive at the moment, with overcapacity resulting in aviation support services being unable to raise prices. And lastly, World Health Organization has declared Ebola as a public health emergency. For the first two bullet points, they are temporary and they do not represent a structural change in the industry. So we think that after time, these concerns should dissipate and things should return to normal. For the competitive landscape faced by airlines, they are expected to be prolonged until the industry can rationalize itself and bring the load factors back to above break even. Investment merits for SIA Engineering is exposure to growth in the air travel capacity without direct risk to fuel costs and passenger load factor. These are primarily the risks that the airlines are taking on where they have no control over fuel costs, and currently they are facing overcapacity, so their load factor isn't above the break-even load factor. Next is the complementary government policies to retain Changi Airport as a regional hub and Singapore as an MRO hub. And SIEC has strong vertical collaboration with both OEMs and the parent airline SIA. Lastly, the SIA pays a dividend and estimated dividend yield of about 4.4% at the current price. To conclude, we have a cumulative rating on SIA Engineering with target price of $4.92. This comes to a conclusion of our presentation. We welcome you to ask questions now. Hi, there's a question on the key comparisons between SIEC and ST Aerospace. So SIEC is only involved in aviation MRO, whereas ST Aerospace, they have 4 business segments. That's aviation, land systems, electronics, and marine. So in terms of business diversification, ST Engineering is more diverse than SIEC. Sorry, I misread the question. There was a key comparisons between SIEC and ST Aerospace. Moving back to the question about what's the key comparison between SIEC and ST Aerospace. Okay, SIEC exposure is only to commercial aircraft, so that's airlines, whereas ST Aerospace, they do for military as well. And currently, if you compare their operations at Changi Airport, SIEC has 6 hangars, whereas ST Aerospace only recently opened their first hangar at Changi Airport. So in terms of capacity, SIEC has a larger capacity for works at Changi compared to ST Aerospace. But ST Aerospace, they have a few hangars at Paya Lebar, where they are doing the MRO for airlines as well as shippers like FedEx. And also at Paya Lebar, they are servicing the military components as well. There's a question on when will SIAEC is expected to hit the target price. We have a 1-year horizon for target price. There's a question on what is the progress of the aviation segment in Singapore and how will this have an impact on SIA engineering. I think I covered that already in one of the slides of the outlook, which is this one. Yeah, this slide is the outlook for aviation sector, specifically to Asia Pacific region. Hi, there's a question on SIA Engineering share price impacted by Ebola. Okay, actually the Ebola virus would more likely to impact the airlines because of the passenger loads. If less people are traveling, so the airlines do not fill up seats. Whereas the SI engineering business isn't so much dependent on airlines filling up seats, but rather airlines actually expanding capacity and flying, because regardless of how packed the aircraft is, they still have to be sent for servicing. I was asked to repeat the previous answer about whether the share price of SIEC I was asked to repeat my answer for whether the share price of SIEC will be impacted by the Ebola issue. Okay, so actually for the Ebola issue, it would impact the airlines more because there would be less people flying and the airlines will not be able to bring their load factor up to the break-even level. Okay, I've been asked to type the reply for that, so I'll type the reply out and I'll let someone else take questions.
Yep, this is Lucas here. There's a questions. Maybe some clarification can be shared on it, but well, I shall just answer you as per what the question is. The question goes like this: isn't outlook for property sector risky given housing price downtrend? All right, let's just give an overall sector outlook here. The housing price is not on a downtrend, not when it's only like 2 quarters of. It's only in this year that there's 2 quarters of slight correction. To actually form a trend for a property sector, you need way more than 2 quarters because, yeah, the property sector is, I mean, the movement are much bigger, and if you're saying that 2 quarters form a trend, then I do not know for the past 5 to 10 years when the sector is constantly trending upwards with maybe 1 quarter of down, 2 quarters of slight correction before it bursts upwards again, whether that considers a trend. So is there a housing price downtrend? Right now, for the past 2 quarters, it is the price outlook is negative. And going for over the next 3 to 4 quarters, we also do not see much upside on that front. So yes, for residential developers, there is a significant higher risk involved. That's why right from I think 3 quarters ago and end of last year, I started to advocate that investors should look at the individual land holdings for these developers and see where are their sites located. Look at the pure fundamentals of these sites, whether it's well located, whether they have there is a reason to believe that these sites will continue to see very strong sales, even given the expected correction in housing prices. For CDL, the reason why we are looking at it in a very optimistic manner is because their sites are very well located. Yeah, and on top of that, the management has also demonstrated some certain level of business savviness. They have never overbid for a land. So for them, even if let's say they were to sell at 30 to 40% discount from their initial launch prices, okay, they will still be able to break even because their profit margin is anywhere between 30 to 40%. So on that front, that's why we are saying that for CDR, I do not really have that much of a downside built in for their Singapore residential because they are largely managed to extract about 30 to 40% this profit margins. And if they are not able to do so, they will at least be able to break even. Yeah, and therefore the indoor investment merits, the reason why I'm advocating CDL for an accumulate is more of the fact that they're going on an expansion profile. They're going to acquire buildings, acquire hotels in UK, Australia, and Japan. And on top of that, there's a fund management segment going to come in soon. So in that sense, well, I hope that that clarifies the part on CDL. It's not just saying that the overall sector is looking good, that's why CDL is a buy. It's more of the fact that CDL is doing well even amidst the fact that the sector is not doing that great. Yep.
Hi, there's a question on dividends for SIAEC. There was no dividends declared in the first quarter yet, so dividend will be declared in the second quarter. But for information, last year the dividend declared in interim dividend was 7 cents. There's a question about how the accidents of Malaysia Airlines will it affect SIA Engineering business. SIA Engineering is MAS is one of the airlines that has given SIAEC the authority to service their line maintenance, but don't think that the loss of 2 aircraft will significantly impact SIA Engineering business.
I have a question on OCBC's right issue. If investors should exit after the right issue. Right. On the dilution side, definitely I think we should be looking about within a 1 to 2% EPS dilution post consolidation of Wing Hang Bank. All right. But how the price is going to move going forward, I think we should await for more clarity from the management as well on what kind of strategic involvement they're going to do to integrate Wing Hang Bank going forward. I think from the last time round, in terms of accretion to ROE as well as EPS, we're looking at about 2017 onwards for Wing Hang Bank. So I think it's going to be quite a bit of integration costs as well as, of course, the impact on your capital ratios, right? So price-wise for our core, we are still neutral in OCBC for quite some time, right? Of course, largely based on the fact that although the OCBC Singapore side's core operations are strong, right, the acquisition of the bank was going to impact its capital ratios as well as the rights issue, which we have just seen today, right? So core is still neutral. Let's wait for more clarity on this first, right?
Hi, there's a question on will the Ebola issue cause the plane to fly less and thus less services required? Yes, that's a possibility because if there's an outbreak and there are less people flying on the planes, the airlines may actually reduce the number of flights. So, yeah, it's possible that SIA Engineering can get impacted by the Ebola issue if it gets serious. Okay, since there are no further questions, we'll end the webinar here. See you next week. Hopefully the audio will be better then. Thanks.